If you own investment properties, you want to make sure that you're investing smart by taking advantage of the 1031 exchange when you're purchasing or selling investment properties. So what is a 1031 exchange? You might have also heard this called a like-kind exchange or even a starker. In this video, we're going to go through the history of 1031 exchanges, some terms that you might hear, some reasons that you might exchange, requirements, what does and doesn't qualify, timing, rules, some tips, basically everything you need to know about the 1031 exchange. And you'll want to stay till the end because I'm going to be giving you some questions that you'll want to ask your QI. And if you don't know what that is, we will cover it in this video, and some information on the Delaware Statutory Trust. This is definitely for more advanced people who are already familiar with 1031 exchange. Hi, my name is Kristen Van Hoekelum, formerly known as Kristen Wilkinson. I'm a local real estate advisor here in Southwest Florida, specializing in 1031 exchanges. So having done a number of these throughout my career, I wanted to bring some knowledge and some information to you, especially if you have your first investment property, if you only own one investment property and this is all new to you. This is information that you're going to want to know before you go ahead and make a call just to any real estate agent. The 1031 exchange has been around for almost 100 years. It started in 1921 when people first started swapping property. Then in 1979, the Starkers made the first exchange. It took them almost 2 years to identify their property, which the IRS did challenge, but the Supreme Court ruled in their favor, hence the term Starker. Regulations came in 1984 with 45-day and 180-day deadlines. The 45-day deadline was the timeline to identify a property, and the 180-day deadline was the timeline to close on a property. And then came Safe Harbor in Southwest Florida. This is important because this means that you can change a vacation home to a primary home using 1031 exchange. When getting involved in a 1031 exchange, you're gonna hear some terms that seem like jargon. It's important to know what those terms are. So we talked about 1031 exchange. People will refer to this sometimes as a like-kind exchange or as a starker. The exchanger is the buyer or seller. Relinquished is the property that's being sold by the property owner in the 1031 exchange. The boot is the money left over. Rule of thumb, never leave money in the boot. The down leg, also known as phase one, is when the seller is selling that investment property. The up leg, or phase two, is when the seller is now purchasing that replacement property. What is a QI? A QI is a qualified individual. This is oftentimes somebody that's at a 1031 exchange company. This is somebody that's going to hold your funds in escrow because that money cannot hit your bank account or your pocketbook. It has to stay in a trust fund account with that qualified individual. Some great reasons to exchange would be if you live in a high tax state and you're looking to take your investment properties out of those high tax states and into another state with lower taxes like Florida to increase your ROI. Another great reason to exchange is if you manage your own investment properties and maybe now you're moving to another state, so you want to sell off your investments and then transfer them over to your new home state so that you can continue to manage your own property. So there's two main requirements when getting involved in a 1031 exchange. The first is that you must be buying and selling property for long-term investments. This is not for your flipper. This is not for somebody that's looking to switch over properties every couple of years. This has to be a long-term investment. And number two is that you must be buying like-kind property for the productive use of trade or business. So we're going to get into qualifiers now, and I think the best place to start is what doesn't qualify. This is much easier to identify than what does qualify. If this is your primary residence, you do not qualify. The 1031 exchange is probably not going to work for you if you're a builder or a flipper. Now, if you purchased a home and you rented it out for 6 months and now you have a ton of equity in it and you plan to roll that over into another investment property or two, that may work. And there can be no stocks, bonds, or partnership interests, and this is why it's important to get your QI involved at an early stage. So then what does qualify? a lease with a 30+ year term, if you own property deeded as tenants in common, or if you own property equal or greater in debt, value, or equity. Okay, we're going to talk about timing, and here's where it's really important to have a team behind you, because it is of the utmost importance that we keep you on track with the 1031 exchange. So let's get into timing. The clock starts to run on the date that the taxpayer transfers the relinquished property. These time frames run simultaneous to each other. They are calendar days, no exception. You have 45 days to identify property. This is not going under contract on a property. This is to identify the property, and this starts the day that you relinquish the property. So you list your investment property for sale in a state like California. You close on that property. Now you have 45 days to identify 3 new properties in, say, the state of Florida. This does not mean that you're under contract on these properties. You're simply identifying them, and you do that through a form with your qualified individual or your 1031 exchange company. Let's take a short break here and talk about a couple of rules when identifying property. There's the 200% rule. Use this if you want to identify more than 3. Aggregate value cannot exceed 200%, and this is commercial mostly. And then there's the 95% rule, which is a little scary, so let's just not do it. And finally, you have 180 days to close on that property. So again, you sell your property in California, and you've now relinquished that property. You have 45 days to identify 3 new properties. 2 of them go under contract, 1 of them is left. You secure it, you now have 180 days to close. The federal capital gains tax is between 15 and 20% right now. That is less state tax, if applicable. Now, my best piece of advice to you is defer it if you can. There is some chatter going around in Congress about getting rid of this tax shelter. So again, defer it if you can. Tip number 2, engage with a QI before listing if you can, but definitely before relinquishing that first property. Super important that you do this. Our team offers concierge service where we line up these 1031 exchange companies for you that are vetted, in addition to any other ancillary services like title services, attorneys, cleaners, you name it. Our number 1 job is to make life easy for you and more lucrative. And of course, with these types of transactions, to make sure that you stay on task and you don't miss those key dates. If you think this would be helpful for you, please give us a call for a free strategy session. You can reach us at 239-571-7082. All right, now I promised that if you stayed to the end, I would give you some questions that you'd want to ask your QI or your 1031 exchange company. So here they are. You'll want to ask, how are exchange proceeds held? Make sure each individual gets their own account and that it's FDIC insured. You're also going to want to ask, what are my insurance or bond amounts? What is your qualified intermediary or individual statuses? And of course, you're going to want to ask, how do you get paid? Rates are all over the place. For a national company, you can expect to pay around $1,500 with an additional $200 or $300 with each additional property. All right, and then finally there's the Delaware Statutory Trust, or the DST. This is where you want to get a financial advisor involved. There's a lot of these going on right now. Huge companies are doing these, and financial advisors sell this product. Basically, it allows multiple investors to own property with professional management. If structured correctly, the investors can trade into and out of the DST interest using a 1031 exchange. Each owner owns a beneficial interest in the DST, and the DST owns 1 or more properties. Some advantages of doing something like this are investment diversification. Sometimes you can avoid management requirements. There's a small balance left over from the replacement purchase left in the exchange account. However, the holding period is between 5 and 7 years because you cannot refinance. All right, that was a lot of information. I'm going to put this together for you now so you can see how this works from start to finish. So Mr. Investor owns an investment property in a state like California. He decides that he's going to move to Florida and he's going to list his investment property for sale. Once that property closes, he's going to identify 3 new properties in his new state like Florida, where he's going to purchase his new investment property within 45 days. And then within 180 days, as the same starting period as the 45 days, he's going to close on that new investment property in that great state like Florida. During this time period, he's going to reach out to a realtor who knows what they're doing so that they can put them in touch with a 1031 exchange company who also knows what they're doing. I hope this video is helpful for you. If you have any questions about 1031 exchanges, if an investment property's fallen into your lap, you don't know what to do with it, or you are like that Mr. Investor and you are going to be moving states, please give us a call. We can book a free strategy session for you. You can reach us at 239-571-7082. We'll see you soon.